At Investor Central, I'm Mark Lowdy with this reality check on AACI Capital Industrial REIT, a real estate investment trust with 26 properties, including this one here at number 20 Gull Way out west in Singapore. You can see that this property is currently being redeveloped, and we'll find out a little bit more about this $155 million redevelopment in just a few moments. What you need to know, though, about AACI Capital Industrial REIT is that the number 2.6 is very important, and it's easy to remember. Their distribution per unit most recently was 2.6 cents. Their debt maturity is about 2.6 years, and their weighted average lease to expiry, that is, the number of years their tenants have left on their leases, is, again, 2.6 years. Again, easy to remember. But like many other real estate investment trusts in Singapore, AACI is currently trading at a discount to valuation, even though it's handing out cash to shareholders. What's going on, and how many more of these redevelopments are they going to undertake? Let's talk to Nick McGrath, the Chief Executive. Follow me. Hello. Nick, nice to meet you.
Mark, it's a pleasure to meet you. How are you?
Thank you so much for making the time.
Thank you.
So here we are at 20 Gull Way. Can you firstly describe to us what's going on here?
Okay, well, thank you. Look, what we're doing here with our partner CWT Limited and the main contractor Precise Engineering, we're building a 5-storey ramp-up warehouse. It's going to be about 1.1 million square feet upon completion. We're expecting the first phase, which is about 700,000 square feet, to complete by the end of this year, and then the balance around about 450 odd thousand to come through sort of middle of next year. So we've basically taken an asset that the REIT bought 5 years ago, and what we're doing is completely transforming it. It's on an enormous site, as you can see. It's like 800,000 square feet plus, and it was previously initially Hewlett Packard's construction facility for photocopiers and things like that. 10 separate story buildings, and what we've done on this asset is hopefully we're going to successfully unlock the potential. We're maximising the plot ratio to 1.1 million square feet. And that also means more money on an annual basis? Yeah, look, it's a significant contributor once the thing is completed. From a DPU point of view, we've made public in our disclosures that the impact's going to be about 15% increase in DPU as a result of this transaction. It's a very significant transaction for the trust. Now, you have 26 properties, and according to the research at Standard & Poor's, 2/3 of them are actually not up to their plot ratio, with some of them even being far below their possible plot ratio. Does that mean you're going to be redeveloping a number of your other buildings as well? Mark, I'd love to say to you and to the investors out there that I've got plenty more of these. This was very much a piece of low-hanging fruit, which happily we've picked. But you're right, I mean, we've got at least half of our portfolio does in fact have underutilised plot ratio. So absolutely, a key part of our strategy for the trust that I think the market has seen to date and will continue to see from us is to try to unlock value, to look to renovate, or as we would say, enhance our assets, or in fact to knock them over and redevelop. That's a key part of our strategy. But that costs money, and even though you have $45 million in unused loans at the moment, how much can you actually realistically take on in order to do all that redevelopment? Sure. Just a point of correction there. We've actually got committed facility of over $200 million. About $150 million is committed for this project, and then over and above that, we've got, I think, sufficient capacity to do what we need to do. So you have 45 million left, fair to say, is that correct? I think we've got closer to about 80 million actually. Just we've got working capital, we've got cash and what have you. Right. I'm happy to say this, we're not looking to raise equity capital anytime in the foreseeable future. We're certainly not on our agenda for calendar year 2012. I think with this project right now we're at 29% leverage, so we're a REIT with one of the lowest levels of leverage in the market. But yeah, look, I think with this project, as we draw down on our investment loan to fund this development, you'll see our leverage go from 29% up to sort of mid to high 30s. You know, a lot of people are talking about recession in 2012, or at least subpar growth. Yeah. How are industrial REITs like these impacted where perhaps office REITs or retail or any of the other types would be doing better? Yep. Well, there's a few things going on actually, Mark. One of the things that's very important for our investors to understand is that the market for these sorts of assets, for warehouse and logistics, is very, very tight. You've seen rents grow significantly. The demand is by far exceeding supply right at the moment. I think we're part of it, we're likely to see an increase in supply over the next 2 or 3 years. But right now, this is a very good spot in the market to be. Most of our tenants are multinational corporations, large third-party logistics companies that have basically used Singapore, chosen to use Singapore as not only their regional base, but in many cases their global logistics base.
But if trade slows, won't they be affected as well?
Sure. Well, it's an interesting point. In many respects, it's kind of counter-cyclical because these large third-party logistics companies that take large chunks of space, and I'm talking 100,000, 200,000 square feet at a time for back-to-back third-party logistics contracts that they've won. When times are not so good, when the economy slows and trade slows down, these guys kind of build up inventory. If stock's not moving, actually, it makes sense, but it's a little bit counterintuitive. They actually need more space to hold the stuff that they're not moving. So, that's certainly the experience we had in the GFC, and it's certainly the experience that we've understood a number of our partners in the industry also experience.
With other REITs, we're also used to longer weighted average lease to expiry. In other words, tenants taking, or some of the leases taking a lot longer before renewal. You've got quite a few due in 2013. Your weighted average lease to expiry is only 2.6 years. Should people be worried about that?
Oh, no, I think people should be looking at that as an opportunity rather than a threat. A couple of things there. The first point is a number of the assets that are reverting from master lease to multi-tenancy this year were bought way back at IPO in 2007. So they were 5-year sale and leaseback transactions with the master lease terminating in this calendar year or early 2013. Essentially, following on from my previous answer, right now is a really good time to be leasing space. So the fact that we've got close to 2.2 million square feet of space reverting to market in the next 12 months is a really good thing. We're expecting significant positive reversion, particularly on 2 of our key assets. So just in big picture terms, we've got 41% of our leases expiring in our FY 2013, which is our period from 1 April 2012 through to 31 March 2013. And of that 2.2 million square feet of space, it's basically 6 assets that are reverting. And of those 6 assets, 2 assets basically constitute 1.7 million square feet of space. One of those assets is 8 and 10 Pandan Crescent, and we've basically released the underlying subtenancies well beyond the master lease period, which, I'm not sure whether you've had a chance to really look at the graph that's in our reports. You can see the legal expiry is 41.9, but the look-through is 33.9. That difference is the fact that we've basically already released 8 and 10 Pandan. The other one is out at Penjuru area, 27 Penjuru Lane. It's basically a carbon copy of what this asset's going to be. It's about 1 million square feet ramp-up warehouse. And that master lease expires at the end of this year. Master lessee goes, but in fact the master lessee doesn't occupy. What we've got is 10 existing subtenants, all of whom have been saying to us they want to stay, and in fact they want more space. So in that sort of environment, I'm expecting increases in rentals rather than decreases. So I certainly see it as an opportunity rather than a threat.
Right, interesting. And obviously from an investor's point of view, they're very happy to hear you say that rents are going to go up. Your tenants probably would much rather they didn't go up so much. How much do you think the market can accommodate in terms of increases, which would keep both the tenants and the investors happy?
Yeah, look, there's been a bit of a hoo-ha. I think you've seen a bit in the press over the last couple of weeks about SMEs complaining about increases in rent. And look, I don't know about the individual cases. Perhaps it's fair enough in some respects, but the majority of our tenants are in fact multinational corporations. We're sort of playing a different part of the market, and it's really been driven by the strength in the market and the fact that there's an imbalance between demand and supply, and that will right itself. So at the moment, as a landlord, we're in a good position. In 2 or 3 years' time, there'll be more supply, and I think at that point, it's probably reasonable to expect some softness. So the key thing for us in our REIT is to really lock down all of these, hopefully these rent increases over the next 12 months, certainly de-risk the REIT by lengthening the WALE, and to get through that increase in supply, which I think will come through in 2014, 2015.
As a CEO, what's your vision for the REIT? Where would you want to be, say, in 5 years' time?
Okay, well, I'll answer that in 2 parts. I'm really happy where we are. I mean, at the moment we're about $900 million worth of assets. I think we've got many more transactions that we can do in Singapore before we look further afield. I mean, we listed as a Pan-Asian REIT 5 years ago. I think the previous management team went and bought one asset in Japan in 2007 at the top of the market. It wasn't a happy experience for the REIT. We had to write off probably about a third of the purchase price. That was obviously reflected through our numbers, and then we sold at a book value. Basically, our strategy is to really focus on what we're good at, which is this sort of thing, grow the asset base, and then I think when we're, I don't know, next say 3+ years, once we're significantly bigger than what we are now, then I think it's time to really start to look overseas. And I think a key differentiator for our REIT versus a number of the other REITs just generally out there in Singapore is the fact that our two sponsors, I mean, we're called AACI Capital Industrial REIT. Both of our sponsors are Australian based, but both sponsors are real estate players. AMP Capital manages 23 billion Aussie of real estate in Australia and in Asia, and its business plan is to grow its business in Asia. AIMS Financial Group has always been a financier of residential mortgages in Australia, and its business plan also is to grow its business in Asia. So I'd like to think as the CEO of the REIT that we'll be able to grow our vehicle accretively and sensibly and moderately, or conservatively really, just safely I suppose, over the next 2 or 3 years. Beyond that, I'm open to the possibility of going overseas, but we'll only go to markets where our sponsors have a presence. And they've got real estate business right now in China, in Japan, and obviously in Australia. Right. So they'll be the key markets for us moving forward.
We'll ask you about that more when the time comes.
Sure.
Now, one final question, and just ignore that the camera's there for a minute. But
right.
If you had to make any concessions at all about a weakness that your REIT has, or an area of management where you could perhaps be better, if there was any skeletons in the closet, what would it be?
Okay, you did warn me there'd be a tricky question, so thank you for that, Mark. Look, I think that if people cast their minds back to 2009, we went through a very painful process. This REIT used to be called MacArthur Cook Industrial REIT. We did a very large recapitalisation where our NAV went from 90 odd cents down to 30 odd cents. It was very painful for investors who had invested at north of $1 at IPO. And through that process, it was a cleansing and a painful, but also a healing process. Since then, I think, if you look at the stats, it's been like chalk and cheese. I mean, the previous management team took the REIT to mid to high 40s leverage. Since the beginning of 2010, we've almost doubled the asset size from about 500 million to just over 900 million, but we've remained leverage neutral at 30%. So I think that people can see that the impact that the new management and the sponsorships brought in terms of dealing with the issues that the trust faced back in 2008 and 2009. I think from an investor's point of view, look, I mean, obviously I'm paid to say this. I think it's a screaming buy. I mean, I'm paying 10 cents plus per annum. I think this transaction alone, this development will see us pay out another 1.5 cents on an annualised basis. We've got really nice growth prospects. I think, an issue for the stock, and we're not alone in this, is that, our asset base is 900 million and market cap's just under 500 million. We're sizable, but we've got to get bigger in order to increase the liquidity of the daily trading volume on the stock exchange. But, look, at the end of the day, I think we've got a number of very loyal investors. We've got our top 5 investors account for over 50% of our register. I think the top 20 is close to 70%. So we've got a number of large institutions and sort of really backed, our sponsors and the management team over the last 2 or 3 years. And I expect that to continue. As we execute on this, as we execute on the releasing that we were talking about earlier, I think the market will reward us. And I'm looking forward to growing the vehicle over the next several years.
It's great to talk to you.
Thanks for your time, Mark.
Thank you for yours and your candid answers.
Sure.
Mick McGrath, the Chief Executive of AIMS AMP Capital Industrial REIT.